Good morning, good afternoon, and good evening, everyone, and welcome to Interpreting Financial Statements, CFO Strategies for CEOs. My name is Colin Mahan, and I'm a Director of Programs at the Nasdaq Entrepreneurial Center. And for those of you who may not know, the Nasdaq Center is a nonprofit improving access and knowledge in entrepreneurship to advance economic progress for all. As you're going to see in the chat in just a moment, the Nasdaq Center provides programs, resources, and exceptional mentorship to help entrepreneurs fuel prosperity, no matter where their journey begins. Be sure to check out those links and resources shared in the chat. Now we're going to launch a few polls to step back and take a temperature gauge on how all of you are doing today. The first poll is how are you feeling about your business right now? Are you optimistic? Are you surviving? Are you anxious? We use this information to guide the programs we provide for this global community of entrepreneurs. If there are any specific topics or challenges you'd like us to create resources for, please share them in the chat. Couple of housekeeping items and notes just before we get started. The first is let us know where you're dialing in from. We'd love to see if you have any neighbors or see if you have any people that you may know out there. Secondly, we're going to have live Q&A near the end of this session, so please submit those questions for us at any time using the Q&A function at the bottom of your screen. We'll do our best to get to as many as we can. While you're answering these polls, I'd like to take a moment and recognize the incredible support of our corporate partners. The work we do at the center wouldn't be possible with all the generosity and belief of our partners and funders, including Nasdaq, Wells Fargo, JP Morgan Chase, KPMG, Walmart, Asia Innovation Hub, Wilson Sonsini, the Nareed Foundation, and BPM. We're deeply grateful for their partnership and hope you'll join us in sharing that appreciation. All right, this other poll that's rolling, what's keeping you up at night? Looks like a pretty decent mix, but looks like sales is in the lead, followed by finance. Good news for many of you because finance is the topic of our discussion today. So without any further delay, please join me in giving a warm welcome to our special presenter. Lindsay Kruit is a CFO at LumiQ. LumiQ? Did I pronounce it right?
LumiQ.
LumiQ. Amazing, Lindsay. I'm so excited for this. And over to you.
Awesome. Thank you, Colin. Get my screen shared here. Okay. Thank you so much for joining, everybody. As Colin pointed out, a lot of you are probably feeling a little bit of uncertainty and anxiety about financials, but we're going to cover off in the presentation, which should take about 40 minutes or so today, some of the fundamental things that will give you a degree of comfort around your company's financial performance, position, and just bolster that financial literacy so that you have more confidence as to what's happening, so that you can be more reactive in a confident sort of way to whatever might be happening or whatever opportunities might be facing you in your business. So I'll get right into it with a little bit of an overview as to who I am and what I'm bringing to the table, just to give you some context. So I work as a chief financial officer, and I do a lot of work in mentoring entrepreneurs, founders, other business leaders. And what I bring to the table today is experience that has been a little bit meandering. I started my career in insurance. I made a move into manufacturing from a forestry perspective. I worked then in a startup context in retail from an apparel angle. I then moved into commodities. I worked in the steel industry, and now I work in tech with a podcast-based CPD compliance technology company that does basically ed tech learning. I have a bit of breadth to my educational background. I'm a designated accountant, but I also do project management, and I'm taking my MBA. Plus, I have an interest in sustainability, climate change, and risk management. The reason I'm bringing this all up to you is not to kind of toot my own horn or anything like that. What I'm trying to tell you is that based on the experience that I've had that has jumped around, moved industries, moved roles. I've worked in organizations that are small startups that are a bit scrappy. I've worked in family-owned, kind of more mature businesses. I've worked at publicly listed organizations. What I'm about to share with you is agnostic to all of that. It doesn't matter where you're coming from, what your background is, what sort of work you do, whether your company is at a certain growth stage, none of that matters. It will not be a highly technical conversation, but it should be a highly relevant conversation so that you can understand how to maximize your organization's value, make sure that you're managing risk carefully, and that you're basically trying to do what it is you are setting out to do to the best of your ability. So let me now cover off for you what we're going to review today. The first thing is I'm just going to take a moment to explain why financial literacy matters. And I know that a lot of you have joined the call today with the context that it matters to a degree enough that you're here to join, you're here to listen. So that's amazing. Let me now build a little bit on that as to how financial literacy can benefit the work that you do, the organizations that you work for, or the businesses that you're trying to build. Then I'm going to start from the bottom up. I'm going to focus in on the building blocks that constitute these financial pictures that we're going to look at, basically. So zooming in on the building blocks that create the core financial data for what's to come. Then we're going to put those building blocks together, and I'm going to walk you through the primary financial statements that are going to matter the most to help you summarize and interpret your business's performance or the organization that you work for, the performance. When I say business and organization, I'm kind of using them interchangeably throughout the presentation. I do mean any sort of an organization that's pursuing some objective, be it a business that is for profit, a not-for-profit, a government entity, whether you're building it, whether you own it, they're all kind of being used interchangeably. So once we have that foundation set, we understand what the financial statements are, then we're going to get into what really matters here. What to watch. How is it that you can look at those statements, which are maybe a little bit daunting, and understand what they are telling you? They're going to help you understand the picture and then make great decisions to drive growth and profitability. Then I'm going to leave time at the end for Q&A. So as I'm going, if you want to take notes on the side as to the questions that you might have, there will be time spared. But don't forget, the session is being recorded today, so you don't need to scramble to take notes. All of this will be available to you as a resource after we're wrapped. By the end of this webinar, these are the key takeaways that I'm hoping you should have answers to. Why is it so important to understand this material? What are the key financial statements? What's included in each of them? But then how do you interpret the critical elements of the financial position your company finds itself in to make good decisions? So let's zoom in on the first thing here. Why does financial literacy matter? There are many different angles that we can take from this. So I'm going to highlight basically 4 key points. The first is for internal purposes. You are running a business, you are running an organization. Having the financial literacy allows you to take a look at the financial statements, the financial reports, and know the relevant answers to the questions that matter for you to make these decisions. For example, do you have enough cash? Are you profitable? What are your areas of risk or concern? Maybe even, what are your opportunities? Next, we have external purposes. So for example, if you wish to borrow money from a bank, they're going to want to see your financial statements or your financial reports. They're going to want to understand your financial health before they lend you money. If you are, for example, applying for supplier credit, you want to pay on credit terms, they are also going to want a sense of your health to know that they can take a risk on lending you this credit, allowing you to pay them later, and then they'll deliver you the goods or services now. Or, for example, you may have external investors, or you might have employees who are option holders or shareholders, for example. These folks are going to be really curious as to the health of the organization because they want to know that they're making this investment and it will pay off over time, either in your business or as an employee, and they're putting in their time. Then there are different time frames that we can look at this financial picture. We can look at the short-term view, and this will allow for us to make point-in-time relevant decisions, such as inventory management decisions. Do you need to buy inventory, sell inventory, write that inventory down? How do you price the product or good that you are selling? How about hiring decisions? Do you have the right people doing the right thing at the right time? Does it make sense based on where you're at? But then you also, of course, on the flip side, want to take a long-term view. This will allow you to make, for example, robust strategic investments into the things that matter, that you know will then drive increased value and help you to manage either decreased or at least acceptable risk. Maybe you're looking to the future as a founder, let's say, to a future exit, or perhaps you wish to list on a public exchange and you want to IPO. Or maybe you're building a business, you're in it for the long haul, and you're looking for generational wealth. Maybe you're going to pass your business down to your next generation, or if you do eventually sell it, you've generated the wealth to then set your family future generations up for success. No matter what angle you're taking, as you're considering financial literacy, the thing to remember is it is for everyone, no matter your background. And I'm so glad that you're all on the call today. And one thing I do really want to drill home is that there are some folks who think about finance and accounting, and they think it's this big, bad, scary thing, or that you need to be a business major, or that you need to be good with math. And I can promise you, none of those things are true. Spoiler alert, I couldn't do mental math to save my life. But I have learned the fundamental skills to be able to leverage this useful tool effectively. And I promise you, if I can do it, you can too. And it's going to unlock so much value for your business or for your career. So let's get into the basics. I mentioned these building blocks. At the end of the day, when it comes to finance, financial reporting, financial literacy, these building blocks we'll call transactions. All business activity creates data. This data, when it's recorded, creates a transaction. The transactions are either recorded directly in the finance system, or they could be recorded indirectly, let's say in a different business system, and then they flow into the finance system, or you manually put them in the finance system. So what I mean by that is some transactions are recorded automatically. Maybe you have a point of sale system that records it kind of naturally. The sale is entered, boom, the transaction is there. Or in some instances, these transactions are entered manually. So you're putting fingertips to keyboard in order to have this transaction be entered, or maybe you're tracking the data point in something like a Google Sheet or Excel sheet. Collecting and structuring this information allows you to have the underlying fundamental building blocks, all these individual transactions that you're then going to piece together to create this picture that I'm going to be talking more about today. But in order to kind of help you wrap your head around it a little bit more, I'm going to use the example of a box of Legos. So for the parents in the room especially, this will really resonate, but I think anybody who was a child who played with Legos can really relate to this. Imagine you've got just this box of different colored Legos in a bin. It's an absolute jumble of different sizes, different colors, and it is so hard to have a sense, just looking at this box, as to how it could come together. Is there more of one, less of another? It's really hard to tell, just all in a jumble. So first, we really need to organize. Imagine you're sorting the containers into, let's start with different pieces of different color. You're putting them into different piles or even into little bins. You could sort a red brick that has 2 by 3 into a pile, for example, with all the other red pieces. And that would allow you to be able to pick quickly by color. But if you're trying to build something, you're building a little Lego house, let's say, it's still a bit of a jumble for size. How do you find exactly what you're looking for? So what you would maybe want to do is then slice it a little bit more, put it into a different bucket where you've got not only color, but also size separated. like pieces with like pieces. It's creating this order from the chaos of Lego pieces that allows you to create the underlying, basically, think of it, now it's your database. This is your collection of nicely, clearly sorted Legos that now you can very quickly piece them together to see what picture is going to be built. Takes a little bit of extra time to either sort it or make sure it never gets jumbled in the first place, but it does pay off in the end, and I'll explain why. So now we've got our Legos or our transactions grouped into buckets. At a minimum, those buckets, from a finance perspective, we're going to call those accounts. However, you can sort your data into more specific buckets. You can sort it first to have your data by transaction for the company. Maybe you're running two different companies. First, you want to sort to keep company by company on their own. Then within a company, maybe you are going to sort for division. Then you're going to sort separately for the transactions by department. Maybe you're tracking for a specific project. Then you're going to have account. You can have many more different ways to slice, dice, and sort this data. You can have a single data point be tagged or grouped into more than one category. But once you've categorized it, it allows you to then have a little bit of order in the chaos from which to build. So once the groups of transactions are assembled, or once they're sorted rather, we then assemble them following standard guides. These guides allow for us to create a clear picture that is comparable. These pictures that we compare are called financial statements. The key financial statements that we're going to cover today are the balance sheet, the income statement, and the cash flow statement. I'm mentioning these guides, and the reason I'm bringing this up is that different jurisdictions or businesses of different types have different guides to follow. So, for example, if you are a multinational corporation and you're listed on a public stock exchange, you operate in different countries, you are most likely required to report under what's called IFRS, International Financial Reporting Standards. If you're a business in the US, you have to follow the guide of US GAAP, US Generally Accepted Accounting Principles. If you're a Canadian business, but you're not publicly listed, you're probably reporting under what's called ASPE or ASPE, which is Accounting Standards for Private Enterprises. There are many, many more for different countries. If you're a government institution, if you're not for profit, there are different standards for different types of organizations, but they create the rule book to follow. Before I get into the statements more specifically, there's a couple other key points that I want to just highlight because they are fundamental to understanding what's to come. The first is a principle called the matching principle. And what this says, according to the guidebooks, is that expenses should be recorded, recognized, reported in the same period, either as the revenues that they help to generate, for example, cost of goods sold, I'll explain that in a bit more in a couple more minutes, or when they are incurred. Let's say it's a legal bill, which can't always be directly linked to the revenue per se, but you want to ensure that you're recognizing and reporting that expense when that legal work happened. This matching principle is fundamental to what's to come. The next principle is what's referred to as revenue recognition principle. And what this one tells us is that sales revenue should be recorded when you earn it, meaning you've basically fulfilled your side of the bargain. You have promised a good or a service to, let's say, your customer. And when you have fulfilled that, you've given them the good, you've done the service, you've fulfilled your end of the bargain. This is when the sales revenue can be recorded. It is not based on when cash is received. And I'll walk you through that in an example to come. You can use a rule of thumb around this that is referred to as the risk and reward transfer rule of thumb. So if you think about the risk and reward associated with, let's say, having some inventory, you're holding on to a widget. If something were to happen to that widget, who is the one who suffers the loss? If it's you, you are bearing the risk. You still have that widget. But if the customer has now the widget in hand, they're able to use it, do something with it, generate some reward from it. Now it's with them. That means it's transferred. Now you can say you may record the revenue for selling them that widget because you have had the transfer of risk and reward. The matching principle and revenue recognition principle go together to what is sometimes referred to as the difference between cash accounting and accrual accounting. These are two bases for accounting. Cash is just as it sounds. It's on the basis of when cash moves. So if you're following this approach, you might, for example, record a sale when you are paid for that sale, or record an expense when you pay for that expense. The cash is moving. This approach is not permitted under most financial standards, any financial standards that I'm personally aware of. Cash accounting is used maybe at best when your business is really young, really just getting going. You're not accountable to anybody but yourself, basically. Cash accounting paints a bit of a distorted picture because the timing can be a little wonky. So this is where, when you apply the matching principle and revenue recognition principle to enter transactions in the system that are sometimes called accruals, they're types of transactions that basically placehold value until the cash comes in, that you're applying the proper basis for reporting these financial statements to these standards for internal and external use. The last one that I want to point out is what's referred to as double entry principle or double entry bookkeeping or accounting. And it can be thought of as there are two sides to every story. Every transaction affects at least two accounts. And this is critical to understand how transactions flow through these finance systems. And I will show you some examples of what I mean by that shortly. But effectively, it allows us to keep our accounts in balance, which is referred to as the balance sheet, or sometimes the statement of financial position. So what the balance sheet shows us is the story of the value that the business controls, which can be thought of as its assets, and how it has financed those assets. It either owns them, which means it has the equity of owning them, or it owes for them. So it has a liability. It owes somebody else or some other company or entity money in order to have got that asset in hand. Think, for example, of a house. The house itself is the asset, but you could either have paid for it outright in cash and that you have full equity in the house is yours, you own it. Or you could have financed that house with a mortgage, in which case you have the liability of having to pay somebody else back for that. Maybe you mortgaged it in full, in which case the full value of the house, the asset, is a liability. Or you maybe have a mix, or it could be fully equity. How a business chooses to finance its assets is kind of up to the company, how much risk it's willing to take on, and a few other minor variables, but it's kind of flexible, to be honest. It doesn't change the value of the organization per se. The balance sheet is always presented at a specific point in time. So it's a snapshot as of a specific date. And it is referred to as a balance sheet because it must always be balanced or equal on both sides of the equation or both sides of the balance sheet. So assets must be equal in value to liabilities plus equity, because this is how you finance a mix of these two things, all of the assets together. Let's go into, as you can see, I've got the balance sheet example over on the right-hand side here, but let me walk you through some examples of the most likely things that you're going to see on a balance sheet to just understand what's going to be reported on these balance sheets if you're looking at them. So first, under the assets section, you're going to have a category called current assets. Most likely, I'd be shocked if it wasn't there, is going to be cash and near cash. This is honestly quite literally cash in the bank, cash that's maybe place held or reserved for something, or extremely short-term, very liquid investments. So maybe like a 1 month or 3 month GIC could be considered near cash. The next might be maybe marketable securities. So this is going to be a liquid, highly liquid investment, but it's a maturity of maybe more than 3 months, but less than a year. So maybe it's a 6 month GIC that you've put your money in. It's still liquid, but it's not quite near cash. The next example is going to be accounts receivable if you're selling anything on credit. The accounts receivable is money that you are owed from the customers for sales you have already made. They're basically IOUs. Your customers owe you money. There's value to be gained there, and so that is considered a current asset. The next you might see is prepaids. These are payments made in advance, like rent paid up front in January or insurance for a policy paid one time per year that you will quote unquote use at a later date, or you'll gain the benefit from it at a later date. So you don't want to just show 12 months worth of something all in one shot on one of your financial statements. You're going to sort of placehold this as an asset and then slowly derive value from it over time. The next one is inventory. And so these are goods that the company has on hand that it has either purchased or produced, that it's going to be consuming while it's running its business, or that it has on hand to be able to sell to customers to generate revenues. You'll notice in this section, the items at the top are very liquid. You can convert them and put them to use immediately. And the ones, as you move further down the list, become less and less liquid. This is intentional. Balance sheets are presented in order of cascading liquidity. So more liquid at the top, less liquid at the bottom. And you'll notice that throughout. The next section is called non-current assets, and this is going to include things such as fixed assets, which are big, long-term things that the company is using to run its business. Tangible items like buildings, machines, vehicles, etc. Contrast that to another type of non-current asset, which is intangible assets. So these are also valuable items, also long-term, but they are the non-physical things that the company uses to run its business. So it could be major software systems it has built in-house or implemented to run its business, patents, etc. The next one could possibly be, it's not on every balance sheet, but it could be goodwill. And if you see this, this is the extra value paid when buying another company over and above the value of the net assets. And if there is basically a premium paid for a company over and above the value of its assets, it's attributed to these sort of intangibly generated, internally generated intangible things. Like there's a premium to brand, there's a premium to reputation, there's a premium to customer relationships. And that's why a higher purchase price was paid than the value of the assets. So this is kind of represented on the financial statements under what we call goodwill. But unless the company has been sold or has bought another company, you wouldn't see this. Then we're going to get into the liabilities section. So under current liabilities, also in order of liquidity, we have accounts payable. So these are bills the company still has to pay to suppliers of goods and services for the goods and services that have already been received or consumed. So you've incurred the expense, but you haven't yet paid for it. Then there's short-term debt, which is loans or other forms of credit like LOCs that must be paid back within the next 12 months. So that's where the short-term piece comes in. It's the 12-month timeline, what's coming up quite soon. And then you might have what's referred to as deferred revenue. So this is money that's been collected from customers before you've delivered the product or service that the customer is entitled to. So sometimes, for example, it is for subscriptions, like software subscriptions that are paid up front, but then the customer is signed up for maybe a 1 year or 2 year timeline. You earn that revenue over time. So you put this payment that they've made onto the balance sheet as deferred revenue. It is a liability because technically if they were, for example, to cancel, you owe them that money back. Then there is long-term debt. And so this, if you have it on your balance sheet, would be loans or bonds, for example, that the company does need to pay back, but not until more than 1 year has passed. So it's further out in the future. Then we have the shareholders' equity section, and this is money that's invested in the company when the owners or shareholders either bought shares in the company or founded the company. Retained earnings represents the net profits that the company kept instead of paying out as dividends, let's say, and they have reinvested these amounts back into the business. They are retaining their earnings. And then last, we have dividends paid, and this would be represented as a negative, and it is amounts that have been taken out of the business, profits that are now given back to shareholders in the form of cash or maybe more stock. The balance of these things together help us to have a picture of the company's financial position at a point in time. But what if we want to see how it is performing? How much is it making, for example? So then we have the income statement. And this one represents a picture of how the company performed within a specific period. So the balance sheet was a point in time, but the income statement is a date range. That date range is typically monthly, quarterly, or annually. It will tell us quite simply how much revenue was earned versus how much expense was incurred in the same period. So again, that matching principle and the revenue recognition principle coming into play. When you're looking at the income statement, some jargon or lingo you might encounter, if folks are referring to the top line, they mean sales revenue. This is how much you're bringing in for what you're selling, for revenues that you have earned. At the very bottom of the income statement, there is the bottom line. That refers to the net income, which is revenues minus operating expenses, minus any other types of expenses, minus income taxes that are, if they're payable, due payable, and that gives you whatever is left over. If you have that as a positive number, you are earning a profit. If it's negative, you have suffered a loss. And then the third financial statement is the cash flow statement. This one is relevant to every business, every operation, because cash is king. I'm sure you've heard this expression. If you haven't, have it burn into your brain. This statement in particular exists because cash is so essential. It warrants a closer examination. This is a financial statement dedicated only to us understanding the sources of cash inflows and outflows over a certain period of time, from a starting point to an ending point. It can be prepared in two different ways. In some cases, you might see it in what's referred to as the indirect method. It starts with net income and it makes some adjustments. And to be honest, this is commonly, it's the accountant's preferred method. And that's because it is easier for accountants to prepare. However, for business owners and folks who are actually using this to run their business, the other method, the direct method, is actually more useful. It's more relevant. I'm showing you the direct method here. It has three categories of cash flows: operations, investing, and financing, and it shows inflows and outflows from each of those categories. A picture of directly where cash is moving within your business within that period. So operations, for example, would be how much money you're earning from the business engaging in sales, how much expense you're incurring. Investing might be, for example, if you are buying a new piece of machinery, you're making a CapEx investment into a fixed asset or an intangible asset. And then financing might be, for example, if you are taking on a loan, you're borrowing money from somebody or you're paying it back. And so that is considered the way in which you finance your business. So that falls into that third category. All of these financial statements are not standalone. What's really cool about them is together they form a picture. They are interconnected. Let me show you some examples. There are many, but I'll go over a few. The first, for example, balance sheet and cash flow statement. The cash balance on the balance sheet is going to be unpacked on the cash flow statement. So there's that connection between them. Inventory, when it is sold, moves from the balance sheet as an asset to what is now considered a cost of goods sold. You had to incur the expense of buying this inventory. So when you sell it, you now match under the matching principle the amount it took for you to buy that inventory in the first place against how much you sold it for. So you get a real sense of what's remaining when you sell it. If you have deferred revenue on your balance sheet, it connects to the income statement when you earn that revenue. It will be moved off of the balance sheet onto the income statement. Then, if you incur an expense, but you haven't paid for it yet, you might see that represented as an expense on the income statement, but it connects to the balance sheet by being represented under accounts payable. When you consume your prepaid, more months have passed and you've used more of your insurance policy, used more of your rental, the space that you're renting, those prepaids get consumed, and you'll see them as expenses on the income statement, aligning with the matching principle. And the last thing I'll point out is that net income, when it is earned what's left over, then makes its way over onto the balance sheet to basically build up the value or slowly erode the value if you're making losses of your business over time. So you can see how deeply connected these financial statements are. And that is in part due to the double entry principle of our financial reporting structures. This is just the way that things are kind of flowing through the business. Everything has an impact in a slightly different way. Let me show you with a more specific example here. So we have inventory. Let's say we're starting, sorry, that shouldn't say cash on hand, that should say inventory on hand. So we have oh, no, catching myself up here. We have cash on hand. We're using that cash to purchase some inventory. When we purchase that inventory and we're paying cash for it, cash decreases on the balance sheet. But there's the other side of it, that double entry, inventory goes up, also on the balance sheet. Then let's say some of that inventory is sold, not all of it, but some of it, and it is delivered to a customer. However, they are going to pay us on net 45 payment terms. So they're not paying us right away. In this case, we have more than one entry. I said that there had to be a minimum of two, but in some cases you can have more. So in this case, this activity within the business has generated 4 different transaction types. First, inventory goes down because we sold it, we gave it to the customer. As a result, cost of goods sold has increased. We needed to record the fact that we incurred this expense, it matched with the revenue that we're earning. In that, revenue increases on the income statement. We've delivered the goods, risk and reward has transferred, we've done our part of the bargain, we can record the inventory. However, the customer hasn't paid us yet, so AR increases, and that lives on the balance sheet. Now, 45 days later, the customer pays us. When they pay us, we get the cash in hand. Cash increases on the balance sheet. However, we no longer have the IOU from the customer, so it is AR that decreases. You'll notice on this transaction, there is no income statement impact, and that's perfect. That's aligning with the matching principle and revenue recognition principle to not have a distortion in a future period for just a little bit of cash settlement in the current period. So let's give another example here. A different customer. We still have more inventory, and so now a different customer is placing a deposit for some of that inventory. However, they're not going to take possession of that inventory until a future month. In this case, they've made their deposit, so cash increases. However, we haven't earned that revenue yet because we haven't transferred the inventory to them. The risk and reward still lies with us. In this case, we must record this as deferred revenue. And in the future, in a following month, when the inventory is delivered to the customer, then we start to see that revenue come through. Inventory decreases when we deliver it to the customer, which then has the corresponding cost of goods sold increase on the income statement. And it is now when we have made the delivery of these goods to the customer that we can record the revenue, so that increases it on the income statement. But the offset to this transaction is to reduce deferred revenue. We have now upheld our end of the bargain. We no longer have this outstanding liability or IOU to our customer, so we can clear that one off. So now let's put the pictures together. How do we interpret these financial statements? What is the thing to watch, or what are the things to watch once you're looking at these three statements? I'm going to walk you through some things that you can calculate or watch on your side to understand the measures that matter most for running your business. The first thing we're going to take a look at is whether or not the business is profitable. One of the measures you can look at for that is called gross margin. In order to calculate that, it is revenue minus cost of goods sold, so at the top of the income statement, divided by revenue. This will tell you if the company is pricing its products high enough above the direct costs, like the cost of the inventory, in order to sustain the rest of its operations. The higher the gross margin, the better. The more you have left over after a sale to cover all of your other costs. However, that's not enough. There are other expenses a business will incur. So we might want to look at what's called net profit margin. This is net income at the bottom of your income statement divided by revenue at the top of your income statement. After everything, bottom line, how much is the company able to keep? How much for every dollar sold is it able to retain? Again, for this one, the higher, the better. Then we want a measure of how the company is performing. It's making these investments, it's engaging in these activities. How well is it doing those things? One of the measures we might want to look at is referred to as return on equity. The investors have invested into this business. You, the founder, own this business. How well is that investment doing for you? For this one, you're going to take net income divided by shareholders' equity, which is on the balance sheet this time. And it's going to tell you a measure of how effectively you or management are using the shareholder money that was invested in order to generate profits. In this case, again, higher equals better. Another measure, or another way that you could look at this one, however, is return on assets. Assets are the things that we are meant to be deriving value from. This is what we have to control and be able to generate something from. How well are we doing that? For this one, you're going to have net income divided by total assets, and it will tell you the efficiency of using those assets to produce earnings. I mentioned cash is king. So we want to know, do we have the ability to cover all of our liabilities if we needed to? One way to look at that is called the current ratio. The current ratio takes all of the current assets on the balance sheet divided by all of the current liabilities on the balance sheet. And what it tells us is if all of the company's liabilities came due immediately, does the company have what it needs to cover them? If this number is less than 1, what it means is that it has more liabilities than current assets to cover those liabilities, so that it does make the business a tiny bit more risky. So bear in mind how likely it is that those current liabilities would come due. But on the other hand, if you go too far beyond a ratio of 1, you're at 3, 4, 5, what it probably means is that you're underutilizing your cash and assets. So maybe you're too risk averse. You should put those cash and assets to greater use. And then this one's not a formula, it's just a measure on one of the financial statements. Cash flow from operations should be monitored very closely to be able to know how cash is flowing through the business and whether the business can sustain itself without relying solely on external financing. Therefore, is it healthy on its own? A few more that we'll look at here very quickly. The debt to equity ratio gives us a measure of leverage. How is the company financing its operations seen on the balance sheet? It's the total debt divided by the total shareholder equity. This will tell you the balance of financing. I mentioned it doesn't necessarily impact the value of the business. However, if it is a high ratio, it does mean that there is more use of debt, and that can become more risky if the company is unable to service that debt. So another measure you'd want to look at is the interest coverage ratio. This will take earnings before interest and taxes divided by interest expense. You want to make sure that you can cover interest expense with your earnings. If the company is earning enough from its operations to meet its debt or interest obligations, that's a good thing. It has to pay those debts. However, if this ratio is less than 2, it does mean that you're at risk of maybe not earning enough within the business to cover that debt. So maybe the debt level is too high. We then have some metrics that we could calculate to understand the business's efficiency or turnover metrics. This, for example, could be asset turnover, inventory turnover, days in AR, how quickly is AR turning over. And they tell us how effectively the company is using its resources. Then lastly, there are some measures that I'm going to call external. They're very common. However, some folks like to refer to them as vanity metrics. I think it's a clear sign that Warren Buffett, for example, does not like looking at EBITDA, likes to look at net income and other measures, because this adds back certain expenses. The logic is it tells you that what it's telling you is the company's core earnings from operations, agnostic to the impact from financing, which would impact the interest expense, jurisdiction, which would impact the tax expense, and investing decisions, which would impact depreciation and amortization on assets. This measure is saying ignore all those things. How is the business doing? A lot of external partners, investors like to see this number. It's commonly compared, but you're basically saying ignore these key elements of how I've chosen to structure my business and only look over here at something that looks a little bit better. Use EBITDA with caution. You really should look at the full picture, including these things. And one added layer I'll include here is that some folks even like to go one step further and have what they call adjusted EBITDA. And this is a measure that actually is not even compliant with the financial reporting standards. It basically makes even more adjustments to EBITDA. And so you might see these in your industry, but just recognize that the prettier a picture you paint might be covering up true operations in the business. So you really should look at these other metrics that I included and pointed out. So let's wrap it all up and bring it all together. We have our three financial statements that have been built from our building block transactions up to these clear, consistently comparable pictures that are going to tell us these important measures of how our company is doing. Profitability, is your company making money? Liquidity, can it meet its short-term obligations? Leverage, is it financially stable in the long term? And efficiency, is it making good use of its resources? Now that you have a fundamental understanding of these various elements of the financial ecosystem, hopefully you're feeling better equipped to not only take maybe a bit of a dipping of the toe into reading your financial statements, or at least you feel more comfortable learning more about this topic, which is absolutely critical to helping you move up in your career, grow your business more successfully, and either way, make exceptional business decisions for your business or your operations going forward. So with that, I'll wrap. Thank you very much for your time and attention, and the floor will be opened now for any questions.
Amazing. Well, Lindsay, shout out to how detailed, but also just really useful all of that was. Bringing me back to business school. All right, well, we got some great questions. If you've got them if you've got questions, drop them into the Q&A box and we'll try our best to get to them all. Let's see. How do you value customer relationships or brand on the goodwill portion of the balance sheet?
Okay, I'll tackle that one. So technically, the short answer is you don't. You would only see those things get valued if your company was sold or if you are trying to value it in a business that you have bought and now you have consolidated that other company into your own business. If you are just running your business, normal, ticking along, you would never be allowed to add these things onto your balance sheet. Let's say, however, you have a major transaction. Your business is sold, a new investor has come in, and there is a shift in the value of your business such that you might see this goodwill coming on. You now see a change in equity due to the new ownership structure and a change in this asset structure, the goodwill. Goodwill is generated by taking the full value of the business. Let's say it's $1 million. But then let's say the business is sold for a purchase price of $1.5 million. The value of the business, $1 million, is the value of the assets, but where did this extra 500,000 come from? The premium on the sale. That gets considered goodwill, and we justify that premium by calling it brand, customer book of business, relationships, whatever helps us sleep at night saying we paid a premium over the value of the assets. So you would only have it basically as a plug number for the difference between the purchase price paid and the value of the assets originally on the balance sheet.
Mhm. Super helpful. If the business receives sponsorships, which statement would it be inputted in? Also, sponsorships vary year to year. How would that make the company look?
I can think of two ways that you might have sponsorships reported on your financial statements. The first might be, let's say, you're just getting a single lump sum. The sponsorship or a grant or some sort of bursary is a lump sum from some entity. That on the income statement would get reported under the section that has sales revenue, which shows you how much you're earning from the business doing what it does, less cost of sales or cost of goods sold. You would then be able to compute your gross revenue from that. Then you would have other income, which is monies earned or brought into the business, but not necessarily just hidden in and under all of the other amounts from its routine operations. You want them separated because this will allow for you to clearly see how much do I make from my operations? How much is this other thing that might go away later at some other point in time? Another way you would maybe see sponsorship come in or any other form of support or so on is, who knows, maybe it affects in some way the inventory investments that you're making. You're able to get some sort of a discount or the amounts of inventory that you're purchasing. The amount you're bringing in is attributable to the product, the good that is living on your balance sheet. What you might do at that time is reduce the value of the inventory, maybe. If you're getting like a special discounted price, which is considered a sponsorship,
Mm.
you would bring the inventory in at its reduced price because you paid a lower value. And then that would just naturally flow through from lower inventory value because I got a good deal on it, I was sponsored or received a break on the price. But then when I sell it, that reduced price goes through to the income statement on the cost of goods sold line.
Okay, awesome. Let's see. Back to Finance 101. Is how does net present value figure into these statements? Is it used at all there? I know it's kind of an estimate.
Hmm.
I need
Net
like
present value is an incredibly useful tool, but it actually doesn't come into play in terms of the presentation of the financials. The financial statements can be looked at as a snapshot of our business in time with the balance sheet and a bit of a historical look from the income statement for performance over, let's say, the last month, last quarter, or last year. So it's a little bit of a here's what we did, but they're always valued in the value of that dollar at that time or whatever currency. However, you want to be able to use those numbers to make decisions for your business. In order to make decisions for the future, you need to try to say, over time, how much money might I earn? Over time, how much investment might I need to make? Those are dollars that span many years into the future, let's say. And we all know because of the time value of money, a dollar today or whatever denomination of currency today is going to be worth less in the future. So it sort of shrinks over time. And what we want to do is represent the value of that shrinking amount if we're trying to say, is it worthwhile making this decision? Is it worthwhile making this investment? Or what is the value of something in the future, looking at it and comparing it to something today? So we would use net present value in order to bring the future dollar into today's comparable measure for decision making. So, in a very roundabout way, you're using net present value to perhaps layer on the time value of money impact to your current earnings. You're saying, I'm earning this much today. I'll earn that much tomorrow, this much next year, so on and so forth. But net present value shrinks it for the time value of money to allow you to say, I'm going to make that decision, make that strategic investment, etc. So it's more an analytical tool that finance uses, but not for financial reporting.
Yeah. Great answer. Okay, let's see. How are the financial ratios and KPIs related?
Financial ratios and KPIs can, in a sense, be thought of as much in the same. KPI stands for Key Performance Indicator. It is some metric or measure that you would look at within your business to say, am I meeting my goals? Am I meeting my targets? Am I achieving what I set out to do? You would set the KPI to say, how will I know if I'm succeeding? It will be if my X KPI achieves Y output. You will be able to have a better sense of your performance by tracking these KPIs. The KPIs could be the ratios. So you could say, my profitability KPI is a 15% net income margin. You would calculate the ratio, and then that would allow you to know the outcome of your KPI to then compare against your target that you set for yourself to say whether you're on track or not. But they don't have to be these ratios. KPIs can be some other things. There can be qualitative measures that are KPIs. There can be other analytical and quantitative measures that I didn't go over today that can also be considered KPIs.
Amazing. Well, Lindsay, we are almost at time, but thank you so much for joining and sharing your CFO expertise with our CEOs, CFOs, COOs, and chief bottle washers out there. Really appreciate you joining us today.
Thank you, Colin. It was an absolute pleasure.
Alrighty. Well, for those of you still on the call, thank you for joining us. We have a bunch of awesome webinars coming up on the horizon, so check those out in the chat. One last poll. Did you gain clarity? And it looks like everyone who's voted says absolutely. So great job, Lindsay, there. But thank you all for joining us. We look forward to seeing you all online soon. Have a good one, everyone.